Right. Today's discussion will be with Raghav Kapoor. He's a co-founder of Smartkarma, a platform for independent research analysts based out of Singapore. And he has a background in the brokerage industry. He co-founded a brokerage firm. He was also at Religare and Citi, back when it was called Citigroup, I believe. But let me, perhaps you can introduce yourself, Raj. What got you interested into stocks and your journey until today?
Hey, Mike, nice to be on. Yeah, and yeah, it's always tough to be doing introductions, but perhaps I'll just focus on what got me started into markets and investing, and not so much the career part. For me, I was on a scholarship program throughout my university degree. I had some very generous sponsors, but at the end of it, I decided not to continue and work with those sponsors. And so I had a huge sum of money to repay to them within 30 days. We're talking about close to 380,000 Sing dollars, which would be about 300,000 US dollars. Well, I just didn't have that money. Neither did my parents. They're both academics in India at that point of time. So I begged and borrowed from friends, paid these guys within 30 days, but then I had to figure out how to return that money to my friends. And that's what got me going into markets. And I'll share a 1-minute anecdote into how powerful that journey was. In those days, I had just started off at Citi within institutional equities. This is early 06. And one of the junior analysts within the financial institutions team had initiated coverage on Hong Kong Exchange. In those days, Hong Kong Exchange was a very unfashionable stock. Nobody took it seriously. People thought they could just buy Hang Seng futures, why buy the exchange? But this analyst had made a very strong case for that exchange, had looked at it many different ways. It was a 90-page initiation report. And I was a very, very young stockbroker at that point of time. I went and pitched it to all my clients. They all laughed me out of the room. Nobody took it seriously. I was pretty despondent, and I thought that was the end of my career in stockbroking, till my mentor, one of the MDs, turned around and said, well, if you like it so much, why don't you buy it yourself? I took a $10,000 loan against my next month's salary from him, went upstairs to the Salman Smith Barney branch, opened my account, and literally used cash to buy Hong Kong Exchange. Now, I couldn't even buy the shares. They were too expensive. There was a lot size issue. So out of frustration, I ended up buying listed warrants on the exchange. And as luck would have it, hindsight, whatever you want to call it, God's grace, within about 3 months' time, the Hong Kong Exchange, the regulators, CSRC on the China side, had announced what was called in those days the Through Train program, or the QDII program. Hong Kong Exchange went from about 70 Hong Kong dollars to 210 Hong Kong dollars very quickly. I made about 16x return on that position. And that was money that I hadn't really seen ever before in my life. And it exposed me to just the power of markets and how they have the potential to change lives. And of course, for the next 5 to 10 years, I never made that kind of return, made a lot of mistakes instead. But I think it informed me in a very powerful way, just how life-changing investing can be, and just how ignored it is from our school curriculums or from even our general dialogue. So it was a superpower that's hidden in plain sight, and really my journey since then has been about just getting better at it.
And has your style of investing changed since then, since that investment?
Yeah, a lot. I think investing is a journey of self-discovery, and it takes a while to hone in on what you feel is your own personal style of investing. And I think we all start off by getting infatuated by ideas very quickly, a tip from a friend, something you read somewhere on Twitter or wherever else, and going and punting some money. Um, to me, I've come quite a long way from that. And I think, over time developed what I think is my own style. But, I think investing is also a little bit social in nature. So I think I've managed to rely on some very close friends of mine as well, with whom we have intellectual debates about our ideas, and we really look at the other side of the coin as much as possible as well. And more often than not, that helps you refine and short select. Shorten that list further and really go with something where you would have the tenacity to hold on for a longer period of time.
So you don't lose the confidence in the stock. You only go for stocks that you have high conviction in.
It's super important. I think one of the things I tell some of my colleagues is, where does the word investing come from? People don't realize, but it comes from the word investra, which comes from the word vastra, which is a Sanskrit word, and it actually means clothes. And more specifically, it's a shroud that your dead body was wrapped around, and it was supposed to be with you through your afterlife and bring you to the other side and so forth. We're getting into mythology here, but it is something that is meant to last and be very durable. And I think we've come from there all the way to understand investing as faster, better, cheaper, quicker, low latency, get in and out quickly, day trade, high frequency, all of that. And so for me, a very, very, very big part is to fight against that tendency and temptation to be quick and look for instant satisfaction, and actually be convicted and confident and long term.
Cool. Now, you mentioned to me a while back that you had a long list of criteria that you used for choosing stocks, and you don't have to mention the entire list, but if you give me a gist of what you're looking for when choosing to invest in a particular stock.
Yeah.
In the universe.
Yeah, I was trying to come up with a good memory aid for listeners today. So I think I've summarized it into a sentence, which is: the amazing leader understands market insights swiftly. I'll repeat that again. The amazing leader understands market insights swiftly. And the first letters of these words are basically what I look for. So T is for track records. So I think, much like when we're hiring somebody to join our team, or even looking at the academic performance of a candidate, we look at track records. And I think the same thing applies to stocks. I try not to get carried away by what a company has done over 12 months, and I look for a much more longer track record of performance, at least 3 to 5 years. And we're looking at very, very simple things. How have they grown revenues? How have they grown profits? How have they increased dividend payments? How have they managed their balance sheets, their cash flows? Just the 4 or 5 very, very simple metrics. And actually, when you search for any company on Smartkarma, the same metrics are shown on the first page of that company. And that gives you a very clear idea of how consistent of a performer a company is. The next thing, amazing, A, is for alignment. I think maybe it's more true in Asia, but it's probably a global thing. But I think you can have some great businesses that don't care for minorities. Or you can have some great businesses with management teams that are not aligned with the original founders of the business. So I think I'm looking for very simple businesses where there's a nice alignment between the main stakeholders of the business, the suppliers, the customers, the shareholders, and so forth. And I think over the long run, you can't go too wrong if you get alignment right. And the best way for me as a small shareholder to understand and secure that alignment is to look for consistent growth in dividend payments to me. So I'm not looking for a high yielder per se, but I'm definitely looking for a company that continues to care for me as a minority by continuing to pay me hard cash back every year and trying to grow that number year on year.
Do you care about the payout ratio? Well, let's say it's a fast-growing company. They only pay out 20%.
No.
Is that okay?
No, I don't. I mean, for example, one of my best historically investments was Tencent. And they never had a high yield, they never had a high payout ratio, but they always grew the absolute dividend amount paid for very, very long periods of time.
Which shows they care about minorities.
That's it. It shows they care about minorities. It shows that the unit economics is improving over time. That's why they have more money to pay you. So it's not cashless growth. You're actually seeing that cash in your bank account, in your brokerage, every quarter or semi-annual or whatever. So I care about that a lot. The next, is leadership. That's the L. So I try my level best to not pick the second or third best company just because it's trading at a discount. So wherever possible, it could be a very small niche, but wherever possible, I try and look for the best company. I think the way I have now come to see it is companies operate in their TAMs, in their addressable markets, and the leader tends to suck up the vast majority of the cash or that revenue opportunity in that TAM, which means it's depriving the number 2, 3, or lower players from that same dollar value. And that becomes a compounding moat over time. You're constantly sucking up more dollar value from that TAM versus your peers. And that helps you continue to grow faster. So leaders continue to remain leaders for long periods of time. That's effectively it. The next U is for unit economics. So I try very, very hard to not invest in companies that are low margin companies. So I'm looking at net margin here. So typically avoid anything that is single digit here. The reason is simple, because all businesses, including the business I operate, Smartkarma, we go through up and down cycles. And if you are a very thin margin company, during a down cycle, you become loss-making. The moment you become loss-making, unless you have a very secure balance sheet, you are suddenly then beholden to the whims and fancies of shareholders. You have capital constraints. And unfortunately, that's when bad decision-making creeps in. Whereas if you can withstand economic shocks because of that more attractive margin structure, you're happy to, you're just much more resilient over time. And you don't have to compromise your business model and do, low quality things during tough times. So that's why unit economics is important. M stands for management access. So I believe a lot in getting to know the management teams that run the companies where I'm investing. It's not always possible, but I try to ensure that is the case for a vast majority of companies that I own. And I think the best way to get management access is by just writing to them and just being honest and authentic and transparent. And just by, just showing a great interest in their business. And I think over time, I've been very fortunate to develop those friendships. In some cases, management teams now, they even start sort of consulting you on certain questions. And I'm saying that from a position of humility. They just want to hear your view, because many times when they go to their institutional shareholders, they get a very scripted answer. They don't get the authentic feedback. And sometimes they want somebody who calls a duck a duck, calls a spade a spade. So that management access. And how it helps me is, again, there will be those times when your stock moves a lot and you have no idea why. I mean, I remember I used to own an Israeli stock many, many years ago. And one morning I woke up and the stock was down 50% because there was a news headline that the police have raided their office. Luckily, in this case, I had developed a relationship with the management team. I organized a call with the CFO, and I asked her what had happened. And she mentioned, well, it's a really, really bad news headline. It's almost as if a competitor wanted the share price to be down. But the truth was that in their sector, in Israel, there was an annual inspection, which was just standard process. And it was the inspectors that had come to do their annual inspection. There's nothing wrong with the company. And you can imagine funds stop lossing out, all sorts of technical flow that follows when your share price is down 50 on a news headline. But having that management access, being able to hear straight from the source helps. Uh, Back in the past, brokers used to do a better job at doing this. And I think going forward, platforms like Smartkarma are going to do a better job at giving corporates and investors the tools required to disintermediate that conversation and make it happen much more easily with less friction going forward. So that's important. The last two things are independence and sizing. I think independence is at the heart of Smartkarma and is a core belief for me. I like being lonely in my investments. I think looking back at where I've made money, it's basically things that didn't move for long periods of time. And it almost made me second guess if I'm right or not. But I think being your own independent mind and thinking about things in your own objective way and not necessarily what's hot or thematic or trendy at that given point in time is important. So that's one. And last is sizing. So simple rule, don't own anything where you don't want to own at least 3%, where you don't want to commit at least 3% of your portfolio to it, because it just will never move the needle. And you will be more inclined to sell it than add more to it. So I do keep small marker positions once in a while. It's more like a to-do list rather than anything else. But I try not to have a 1% position or a 2% position. It's just waste of time. So own it if you can size it, else don't own it. So 3% is kind of like the minimum for it to qualify being in my kind of portfolio, personal portfolio. But that's a sort of a summary view of the sort of things I do when I invest.
Cool. Now, you started the platform Smartkarma back, I think, in 2014 or so.
Yeah.
Can you tell us about what you do there, Smartkarma, and your vision for the company, and also how you use the platform yourself to get
I'll break
insights
down
on Asian equities.
So a little bit before I started Smartkarma, I was thinking of setting up a family office, and prior to that, I think I came from an institutional equities world, large investment banks dealing with large tier one asset managers, hedge funds, and so forth. But when I started thinking about a smaller investor like a family office, I suddenly realized that there is a very, very wide gap between the availability of high quality service and insight and information that a tier one manager gets versus what a smaller guy gets. And to me, that was an interesting business problem. At the same time, I had a very, very core belief that expertise is not confined to the glass walls of an investment bank. There is no monopoly that the large banks have on the top talent. And if anything, the availability and the democratization of data, of financial data and alternative data means that this expertise will fragment, and that fragmentation will continue to accelerate over time. So, if those were sort of three key ingredients, and the fourth one was regulatory change. I was starting to see this traditional buy-side, sell-side model coming under a lot of pressure, both in terms of performance and regulation. Things like MiFID and so forth that were changing the way investors were procuring, paying, and consuming services from banks. All of that combined sort of led me to Smartkarma. We wanted to be a platform that allows the boutique and the independent research provider to get global distribution, bigger and more powerful than the distribution they maybe previously enjoyed when they used to work at a bank or buy-side firm. We wanted to build it to the highest institutional standards so that the best and the biggest investors in the world could become clients. We also wanted to make sure that it is very, very, very scalable by leveraging technology. We wanted to change unit economics of consumption. Around the time we were starting off, media, traditional media, music, and films were moving from old media to new models like Spotify and Netflix, which were changing the models of consumption. And we felt the same could happen with research. And at the same time, I think if you put the investor hat on, you don't want to pay like 10,000 different subscriptions. You don't want fragmentation. Fragmentation is a tough problem to deal with, especially if you're an institution. So we wanted to make it easier for investors to interface with a fragmented universe of insight providers. And all of that led to Smartkarma. And one of our main slides when we were starting out was that insight sits at the center of the capital markets ecosystem. Whether you're an issuer, whether you're an investor, whether you are a research provider, a trader, an exchange, a private wealth, a private banker, the one thing that touches everybody is high quality insight. And it's that flow of insight and information that leads to the flow of capital. And that virtuous cycle is capital markets. And we wanted Smartkarma to be the company that points to the future of that insight flow within capital markets and partner with everybody else in the world that is helping people, create a new product or allow trading or bring a new security to market. So we did not want to handle the flow of capital. We wanted to handle the flow of insight. That's the genesis. What I do, I use Smartkarma all the time. It's a great way for me to get new ideas from very, very smart analysts that are situated on the ground all over the world, looking at companies and coming up with mean and market variant independent thoughts. It allows me to do very quick research on those companies, looking at things that I was mentioning, what are their track records, what do those report cards look like, what are the shareholders, so on and so forth. It allows me to interact with the analysts, have discussions, private message them, bounce more ideas in a more one-on-one way. And these are all credible people. This is not a forum on Reddit or Twitter or elsewhere where people are pseudonymous. These are all verified people with very strong credentials that have been carefully curated to bring their expertise on the platform. And lastly, it allows me to monitor this on an ongoing basis. So, we've got some very, very simple features. For instance, when I go and look at my watch list, which I do many times a day, I don't just see prices. Frankly, I don't care about prices. I care about the updates on those stocks, whether there's new research, new discussions, exchange filings, earnings calls, transcripts, all that information in one place quickly. I want to get alerted every time something is important. We're rolling out a new feature, spoiler, soon, where you will get informed when an important insider trade stock in a company that you care about. And not just that trade. I mean, those notifications are plentiful, but you'll get the full track record of that executive. How have their trades in the past been determinants of future price performance? That sort of analytics is very close to the heart of Smartkarma as well. And Smartkarma is multi-asset in nature. We obviously do equities, but that's not it. It's bonds, it's private companies, it's global macro, increasingly commodities. We announced a very important acquisition just yesterday, where we've acquired a business called HelixStep that is a really exciting commodities alternative data platform that brings primary pricing data right from farm gate level in some very important commodities that are a critical part of the EV supply chain. So I think anything that's niche, that's differentiated, that's proprietary, that will move markets, we want that to be a part of Smartkarma's story going forward.
Cool. Fantastic. I mean, so your investing journey, you've been based in Asia for most of the time, from my understanding, Hong Kong and then Singapore. So you have experience investing in this part of the world. I'm curious, what's your current focus, and let's say, like, throughout your career investing in specifically Southeast Asia, what have been your learnings, and what lessons can you give, or what kind of advice can you give to investors who may not have this kind of experience you have?
I think maybe the first and foremost is just be independent and bottom up. Avoid noise. Every few years somebody will come and scare you. This currency is going to go to zero, or this, all sorts of tail risk scenarios that are painted. But countries move on, demographics keep moving these economies forward, businesses keep growing. So long as you have followed that checklist or a close enough checklist, you're going to be fine. So I try to ensure that I know the companies that I own very well.
Hmm.
And I try not to worry too much about everything else because, frankly, nobody really knows. There's a lot of pundits out there. There are very few, you know,
Hmm.
guys with crystal balls per se. So, knowing your companies, knowing those businesses, making sure they are simple, straightforward, have some of those characteristics we described. That's the first thing. Second thing, as I said, I like to be lonely when I invest. So I look for pockets of value that people have abandoned, sometimes largely for technical reasons. I think Mike, I've been building a strong case for Philippines markets for 2 years. 35% of my personal portfolio is in that market. Uh,
Hmm.
when I was building up that book, people were telling me the peso is going to go to 100, and Marco is not going to be good for market, whatever. I heard all of those things. And I frankly had to just mute it all down. I had to just care about the businesses that I was putting money with and whether they were going to give me returns. So,
What did you see in the Philippine equities at that time? What making you make such a big bet on Philippine equities?
okay, so it's always three things: fundamentals, valuations, and technicals. So, on fundamentals, this is a country with close to 120 million people. It's growing at roughly 5% clip a year. The demographics are quite favorable. It's got a very, very unique geopolitical significance because of US military ties and bases and so on and so forth. Um, you know, and there were sort of interesting political developments happening on the ground, which all of them pointed to very, very decent growth for the country and for companies. So fundamentals were good. I mean, my 11-year-old son can take a trip to Manila and say, "This is pretty good. Everything is fine. People are buying. People are consuming. It's fine." Uh, the other thing is valuations. So Philippines back in 06, 07 was like the most expensive and best performing market in Asia. It was the most profitable market for ECM, for UBS in all of Asia at
Wow,
that
it's crazy.
time. And from there, it had fallen completely out of favor. It was super cheap. The largest conglomerates, the Ayalas, the SMs of the world, were trading at deep discounts to NAV. Uh, you know, the insider buying had picked up quite a bit. So, you could see all the signs that this is a cheap market, which brings me to that technicals point. So, there were important technical reasons why there was this growing disconnect between fundamentals and valuation. And that was the benchmark weighting. So Philippines had dropped to 0.5% weight in the benchmark, not even 1%.
Is that MSCI Asia
Yeah,
ex-Japan? Or, yeah.
right. Yeah. Now, when you drop to below 1% as an institution, you just don't care. You just don't care. So literally institutional investors had forgotten that there is a market out here called the Philippines, where there are good companies that are growing very nicely. That's it. So for me, that was the setup. Now, um, I started doing my desktop research. I even did trips on the ground. In November, I spent 3 days with another insight provider on Smartkarma, Samit and Asia. We went and met companies, and the story was amazing. Every place that we sent in an email to meet them wanted to meet us.
Hmm.
When we went and met them, we asked them, "Guys, we're just small personal investors. Why are you meeting with us?" They said, "Well, nobody's come to meet us in years. Thanks for
When was this?
November last year."
Oh wow.
So, my very first meeting after we landed at the airport was with the Philippine Stock Exchange. And we were fortunate enough to get like 2 CXOs, 3 analysts, 2 VPs, whatever, like several people coming in to meet us. We went to see Ayala Land Logistics, and they were so kind. They opened up the boardroom, they bought us lunch. It was the CEO, the COO, the head of strategy, head of IR. They had so much time for us.
And that's a big company as well. Ayala Land is a huge company.
Yeah, this is the logistics subsidiary, but
Right.
yeah, but I mean, and it was the same story over and over and over again. I went and met Gcash, which is going to be one of the most amazing IPOs coming up in the next 12 to 18 months. We met the lovely CFO of that company. We had breakfast with him. We were getting great management access because you could see this big disconnect between buyers and sellers. There was just very few buyers in that market. So we could be a decent sized fish in what had become a small pond. That's always great. But the second thing is, it was an opportunity for you to really cherry pick the best companies and really do that primary research on the ground, not rely on a hot market where everybody is writing on everything just because there are deals coming. But you could pick companies that don't need capital, that are paying out capital, and buy them at inexpensive prices. So that's what we did. That's what I did. So I found enough really good stories where I built enough conviction to scale it up.
Interesting. And you mentioned Ayala. I'm personally interested in your view on Ayala REIT, which you mentioned, I guess, last week or so. What do you think about the management team or the family, I suppose? And also, what's the case there in particular? Because REITs, I guess that's an unusual.
Yeah,
I guess you're not a REIT investor normally, are you?
I'm not. And I actually don't own Ayala REIT at this juncture, but I'm pretty sure I will own. I have owned it, and I will own it again as well.
Okay.
So for me, it's just, if you go to Metro Manila, you go to Makati, you walk around, and literally, I think almost every step you take is an Ayala property.
Yeah.
They really own the best assets, not just in Metro Manila, but across the country. That's a big country. Now, that's the starting point. That's the moat. You own the best of the best of the best. Now, if you now mirror that with capital markets reform, one of the biggest things that the country has done over the last 5 years is adopt a REIT code. And we know what REIT codes do. They allow asset-heavy businesses to free up their balance sheet and increase their, asset multipliers. So you got the best landlord, and you've got capital market reform, and the combination of that is Ayala Land REIT. And the best sign that the parent could give you is that for the first several asset injections that they did into the REIT, they refused to take cash. They just took more units and more units and more units. Imagine you've just listed a REIT and you've listed it to free up balance sheet, but then you are happy to take more and more units in that same REIT. So they were telling you that the REIT is mispriced relative to the strength of the pipeline that's going to go in. So, interest rates were high. People had shunned equities. They were all hiding in bonds. This thing was trading very cheap. It was at net cash. This was a REIT at net cash. I think it still might be. I'm not 100% sure. I have to check. But it's the most dominant REIT. It's like, yeah, you get the best parent reform net cash as a REIT. So you get that whole buffer. They already told you the pipeline for the next 5 years. You can go see any of these assets. They're the best assets. You're never going to have problems with occupancy. And you have to remember, in countries like Philippines, Indonesia, Thailand, India, over time, insurance companies will become very, very big. They'll have huge floats. And they buy more REIT-like instruments than straight up equities. So this thing is just going to have secular demand thanks to that pension pot, insurance pot over time. And it will make its way into all sorts of indices. And you're starting off at a time when Philippines as a whole, as a country, is 0.5% in the benchmark. So I only see upside. So you should, and what Philippines analysts do, it's quite extraordinary. If you follow the sell side community in Philippines, they're amazing at giving you a price forecast that is current price plus or minus 20%. That's it. So they're amazing. They probably know the companies really well, and they have a price somewhere at the back of their mind, which is their genuine fair price for a company. But when they actually publish, it's just always plus or minus 20%. They never take a big stand. So if you just do a simple analysis, just project what the asset base of this company is going to be like in 5 years based on what they've already announced, and assume a 30% gearing ratio, which is comfortable for a company that size, I think it'll lead to some very simple analysis on how big this could be.
Okay. Cool. How about DigiPlus? That's a more a story with a significant amount of change. I suppose the regulation has enabled the rise of this online gambling industry. Can you talk
Yeah.
about that?
Yeah, DigiPlus is an interesting one. Uh, I so you know I've I love owning consumer names in companies in countries like Philippines or Indonesia and so on. But the consumption patterns in these countries are changing a lot faster than people expect. Just take Philippines for an example. 10 years ago, the hottest stories, the fastest growing things were department stores, hypermarkets, retailers. And 10 years on, the online economy is eclipsing or cannibalizing a lot of that and growing a lot faster. So these economies have digitalized very, very quickly, and COVID has been an accelerant. So almost every industry, you have the potential of having a new leader. And that's what I saw in Philippines. Philippines, the consumer loves gambling. They've had a history of cockfights and casinos and all of that for many, many years, right? They've got a gaming regulator, PAGCOR, as well, that exists. So the simplest change was that during the COVID period, when casinos had pretty much shut down, the regulator decided to allow online gambling just as a way of raising some finances. And Melco, which operated a physical casino in Manila called City of Dreams, some of their management teams saw that as a great opportunity and joined this group called which is now called DigiPlus, and built an online gaming business. And in the last 3 to 4 years, the psyche of the consumer has changed. They don't understand why they need to get out of their house and go to a casino only to play at a table where the minimum bet size is 1,000 peso, when they can open their phone, log into an app, trade with a minimum bet size of like 5 peso, and be doing it at any given point of time. So, you've gone from like a purely offline market to a why offline market. And I think now the investor psyche is changing as well. Why do you need to spend in all this capex and build this physical infrastructure and then hope that because you build it, they'll come? And they've gone more to this online mode. Now, this is not a space that is going to be devoid of regulatory risk. In fact, there's going to be a lot of regulatory risk. But I like this as an opportunity because you could find an industry that was going to grow at about 60 to 80% CAGR for the next 5 years, take share from an existing industry, had regulatory tailwinds, at least for now, and a very clear leader, DigiPlus, which had more than 50% market share, and was willing to pay you dividends to prove that the cash was real, had credible international management, a good investor relations team that can articulate that story, share high frequency metrics with an international investor base, and not require any capital. So, this has been a 5-bagger in the last 12 months. It's still the single digit PE stock. It's still going to grow 200 to 300% year on year. And guess how many brokers cover it? One. That's it.
That's Smartkarma.
Well, no, we are not a broker. CLSA covers the stock. It's a great analyst who covers it, knows the company really well. But, we've discussed how those analysts actually cover the stock. At any given point of time, it'll be current price plus minus 20, 25%. And that's about it. So you have the opportunity to take a 3-year view or a 2-year view and, just do your own work, frankly, and go and meet the company and go and, see the assets or use the app and, just do the basic stuff. Not much. So DigiPlus is that kind of story. But my biggest investments in Philippines are the stock exchange, another company that you've covered, Ginebra San Miguel, the gin leader, or
Yep.
Keepers, which is the largest international alcohol distributor. So they're all quasi monopolies. Like Hinebra is 97% market share. And believe it or not, that market share is still increasing. They're still squeezing out the other 3%. Or Keepers, which is pretty much a monopoly on every international liquor bottle that gets sold in that country. It's extraordinary that a business like that exists. Or the stock exchange, which is a monopoly by construct and makes a 60% net margin even in bad years. So there's a lot of really good stuff that people just don't know. Stock exchange has no coverage. Hinebra has no analyst coverage. I think Keepers has no analyst coverage. Maybe one local broker covers it now, but yeah, and all of them have good, investor relations departments, and they put out disclosure, and you can build your own models. And these are not complex stories that rely on financial engineering. It's a very simple stories to explain to anybody.
Oh, okay. Interesting. What about Indonesia? What's your current top-down view on that market and the currency, the rupiah?
I'm actually really bearish Indonesia. And I say that with a little bit of inertia in my voice because I still own quite a bit of Indonesia in my portfolio. But I am certainly of the view that Indonesia is a complacent long for people right now. There's, with a lot of these countries, you have to pay a lot of attention to not just the monetary cycle, but also the fiscal cycle. And I think Indonesia is on the wrong end of that fiscal cycle. I think the leadership change, the new regime, is probably, and I might be wrong here, but my view based on everything I've read on our platform and generally speaking to people on the ground is that you're going to see very, very high credit growth. We're already cycling 12.5% loan growth in Indonesia. It's a matter of time before we see overheating in that market of some sort. And also, I think some of these fiscal policies are probably going to tip that market into the wrong kind of deficit, and which is not going to be currency positive. I think it'll be currency negative. I think there's a bit of a complacency in the mind of investors now that Indonesia, the IDR or the INR, Indonesia and India used to be the two weak currencies, but they've become strong currencies. They've been pretty resilient. And I think in Indonesia's case, some of that confidence might be misplaced. And that's where I think the risk lie. And if you look at the valuations of the large caps in that country, it's not cheap. The big cap banks are over 3.5 times book. So there is quite a lot of money that is sitting there through EDFs and through active managers, and it's been the right call. But I think there is change coming, and that change might be incrementally negative. So, but that doesn't detract me from the longer term story, but the next 5 years might be difficult from a macro perspective. So I think I've been looking quite desperately for dollar earners as opposed to IDR earners. There's, I've been very lucky to again find at least one that I feel strongly about, which is Cardig Aero Services. It's a leader in a duopoly. It's the leading aircraft maintenance, airport services, ground crew handling, and in-flight catering business in the country, which is trading on 2.5 times EBITDA and can grow at like 30 to 40% a year till my kids go to university at least. So, long runway, very secular, dollar earner, but exposed to domestic consumption and international expansion of the economy. And strangely enough, outside of the commodity stocks in Indonesia, there are very, very few dollar earners that you can find in the listed universe that are investable. But let's see. at least I'm kind of partly hedging my exposure by having a large dollar earner position. But let's see over time how that pans out.
And on Carnegie, how are they affected by a potential shift of the capital to East Kalimantan? Do you know? Yeah.
Now, the way is with Cardig handles pretty much all the international airlines that fly to Indonesia.
Right.
So the way contracts are divided is there's Garuda. There is a Garuda asset which does similar business. They
It's
handle
connected to Garuda, isn't it? I mean, Cardig.
No, Cardig is not. So I'm
It's
saying
not.
there are two players in the market. There's Cardig and Garuda. So
Oh,
Garuda handles the domestic carriers,
Mhm.
and Cardig handles the international carriers.
Okay.
Okay, and that's how they split up the nation. So if Singapore Airlines or Etihad or Qatar or Emirates are flying into Indonesia, they will go to a Cardig for help with the MRO side, the ground handling side, and on top of that, Cardig also manages certain airports, like Denpasar, the Bali airport, is managed by one of their subsidiaries. So, and I think the country has a long way to go in terms of new airports and all of that. So it's very professionally run. It's not an SOE. Actually, SATS from Singapore is the second largest shareholder now. I think they own close to 30%, 28%, roughly there. MTech has just purchased a big stake in that business. They've bought out the local family. So you've got one leading future forward conglomerate and the leading, ground handling business in Asia, both on the helm. It's a sub $200 million market cap company that has 40% of market cap in net cash. They're about to resume dividend payouts, hopefully, fingers crossed. I'm urging them to. Cheap as chips, 2.5 times EBITDA. Seriously, I mean, if you just peg it to like the average or median multiple of all its peers, it's like 400% upside from here. So we'll see where it goes. But I think
on EBITDA basis, you're saying the multiple is low.
Either, I think 8 to 10 times EBITDA is pretty common for something like that.
Right.
This is not an asset-heavy business. Remember, it's an asset-light business actually.
Sure.
Yeah, but let's see. Again, these stocks have a tendency of doing well for a while and then not doing anything for a period of time because there's very little discovery. Sometimes liquidity is low, but as long as I get that alignment and the access and the conviction stays high, you stay with them for a period of time because they catch up very fast. Like they won't do anything for a year and then next year they're like double, right? So your IRR comes in lumps, unlike large caps, and I'm okay with that
because you're a long-term shareholder.
Yeah.
So I'm interested in your view on the new General Secretary To Lam in Vietnam. Do you have a view on him?
No view, man. Honestly. But my view, my only view of Vietnam is that it's just a spectacularly good macro story. And the whole China plus one, we all know that, everyone knows that. But that's not it. I think there are 3 things that are really worth noting, which are much better than people expect. The first is what's happening to Bangladesh. So I think Bangladesh has been the other China plus one beneficiary, especially on the textile manufacturing side. And the events of the last 3 months have tarnished that appeal. And I think some of that customer demand that was going towards Bangladesh is going to get rerouted towards Vietnam. It's the only place, in my opinion, in Asia that can handle the scale and capacity that's required going forward for certain key manufacturing sectors. And Sri Lanka's subscale, Bangladesh is kind of question marks now. India's just going to do domestic stuff more than anything else. So it's a very, very, very big part of that supply chain equation. And I have no clue on which way the US elections go, but I think either way, it's a really good place to be, irrespective of what the outcome of that election is going to be. So I like that. The second big thing is Vietnamese are really good engineers. I mean, some of our tech developers at Smartkarma are Vietnamese. They are very, very good. They're highly skilled in mathematics. They're very good at computer science, and their communication skills are rapidly improving as well. I mean, if you're a shareholder or if you've looked at the share price chart of FPT, which is the Infosys of Vietnam, you'll see that it's way underpriced. People still think of Vietnam as a factory, but I think it's going to be a big services play. And I think that's really underrated, and the kind of multiple expansion that comes when you get not just a manufacturing economy, but manufacturing plus services going at the same time. That's two. And I think that the third thing with Vietnam is I think it's a really beautiful country. It's still very underexplored from a tourism standpoint. There's sort of few little exceptions to it, but Hoi An, Da Nang, Phu Quoc, there's just the beautiful parts of Vietnam. And I think if you look at Thailand, at one point of time, 20% of GDP was tourism linked, directly or indirectly. Vietnam's got a long way to go. So you've got this country here that has great intellectual capital, is growing its seat for manufacturing, it's growing its seat for services, and has a tourism angle to it as well. My goodness, you can be on fire from a GDP perspective. So all you need to do is to avoid businesses that are kind of unfavorable in the sort of governmental regime that Vietnam has. Sure. That's it. Like just find other things, like there's plenty of stuff. You can just stay out of those certain sectors that are controversial. You don't have to be in real estate. That's it. And there's enough happening from a macro standpoint that'll make sure you make great money.
Okay. Cool. What about India or China or other parts of Asia? What would you say to investors who ask you about India or China?
I think I have a sort of a muted view on India. I mean, and I say muted because fundamentals are really strong. I think technicals are pretty good too. Valuations are not great. So people are paying a very, very high, they're just paying a lot to get that stream of earnings from India. And again, I know for a fact that these things are cyclical in nature. They're good times, they're bad times. So I'm not jumping in a big way. All I'm trying to do with India is to find, again, very esoteric ways to gain exposure here and there. The other thing also is that I don't invest domestically into those equities. Like I've just never had, I've never worked in India. I don't really have a tax file in India, so it's a bit complicated. I don't want to be an ETF investor in India. It's largely a mid-cap story rather than a large cap story. So I just find other ways to gain exposure to that market.
Through ADRs and such?
Not even ADRs, but there are enough. I mean, I'll give you an example. Not that I own it, but just as an example, the big story behind Hyundai this year is its India IPO. The big story behind LG now is its India IPO. I mean, there's enough global businesses where large swaths of their future valuation are going to be from India. Suzuki, Maruti. I mean, we know these. There's others that are tucked away that are not so obvious. So my desire is going to be to play India surreptitiously as opposed to directly.
Cool. What about Chinese stocks? Any views? Top-down views?
Yeah, definitely. So okay, let's break Chinese stocks into Hong Kong listed and sort of mainland China A shares. I'm not following A shares very closely right now. Hong Kong, yes, I am. Within Hong Kong, my view is really simple. I think the biggest pocket opportunity I see is in what I call wrongly domiciled companies. And by that, I do not mean the Samsonites and the L'Occitans and so on.
Okay.
I mean the companies that are actually have zero revenue from Hong Kong or China, that are just somehow listed there. Or maybe there was a time in the past when they used to have something to do with China, but they've moved out, but they're still listed there. So I'm playing exchange arbitrage. The market is extremely cheap, and these stocks are orphaned, but they have no ties to that place, really.
You think about First Pacific?
Yes,
Megacon?
that's one name, but there's loads. There's
Yeah.
loads. I mean, there's another name I think that you know quite well. Again, I don't have a hugely strong view on the stock at the moment, but it's just as an example, Dream International. It's a Korean company that manufactures in Vietnam and in Indonesia going forward. That's listed in Hong Kong. I mean, management team sits in Singapore.
Oh, really? Wow.
If they were to list in Singapore or Vietnam, I mean, they would get a much higher multiple. I think Dream is like double-digit dividend yield, 4 or 5 times PE, very minority friendly, and there's loads like that, So I think that's the hunting ground. And for me, within that hunting ground, again, I know you've recently picked up on it. I've been talking about it for a while, but my favorite is the textile sector. It's freaking forgotten. Like, there was a time when there were several analysts covering the sector. Now it's crickets. So, I've been noticing how a lot of the textile companies that are fundamentally very good companies, they care a lot about their minorities. They've realized that they need to reduce their dependence on China for manufacturing. And they need to win back some of the business they lost because of trade war last time around when Trump was in power. And they've taken some very concrete steps. They've put in a lot of capex to move those entire manufacturing bases out. And guess what? The market just doesn't realize it. They're just not even reading the announcements from the companies. The companies are saying our order books are surging, our customers are coming back. We're going to be paying a lot of dividends. So some of these stocks are trading on like 30, 35, 40, 50% forward yields.
You talk about Pacific Textiles? No.
It's one of them. It's definitely one of them.
Okay.
I mean, I think Pacific is close to 30% dividend yield, 1 year forward, year and a half forward.
Wow.
But it might get delayed by a quarter, whatever. Who cares? Who cares? We know for a fact that when their earnings come, which is a matter of time, they will pay it out. And you know that because Torre is sitting up there as a near 30% shareholder who paid 10 Hong Kong dollars a share to buy that stake. And the current share price is $1.50. And the
they've
business,
been very generous in the past in terms of payout ratio and such.
correct. It's a 90 to 100% payout company, which will see a 60 to 90% earnings CAGR for the next 3 years.
Yeah, it's interesting, right?
So Dream International was a 10 bagger after they moved their factories from China to Vietnam. That's 10x return on a company that is not as high up in their value chain as Pacific is. Pacific is in many ways a leader. They're one of the most, automated, mechanized, again, textile manufacturers with some of the best clients in the world, like Uniqlo and so on. And they're totally forgotten.
10x, and it still trades at 4 times earnings or 5 times earnings.
Correct. So I think there are some very interesting forces at work. Listed companies, if you think of listed companies as customers, then who are they customers of? They're customers of exchanges, right? So exchanges are competing to get listings and to have listed companies. And I think given the last few years where capital markets have been quieter, a lot of exchanges are going to vie now. They're going to compete a lot harder in the next 3 years to get listings. And if you're wrongly domiciled, you're going to lose that listing and it's going to move elsewhere. Look at PC Partner. Another Hong Kong company just announced they're going to dual list in Singapore and maybe over time shift primary listing there. But again, I just think a lot of exchanges are going to compete
Yeah.
for issuers. And I think issuers, unless they have strong ties to a particular geography, have a choice to move around. And
so CK infrastructure and Samsonite wants to do it as well.
Correct. So I think again, we're looking for alignment here, right? If the founders themselves are unhappy about their share price, or the larger shareholders are unhappy, or there's a clear path to you seeing a higher capital return from these companies. So I think now's the time to dust the covers off of those forgotten things. And yeah, Smartkarma is going to be doing, I think, a tremendous job at highlighting these situations.
Fantastic. Yeah, awesome. Just one question I want to ask you. I'm a huge book lover. I love to read books and learn more that way. Are there any books that you think are helpful for investors, either about the countries here or specifically investing stories or anything like that about Asian equities?
Look, I'm going to give you a totally wrong answer. I'd like to recommend a book that doesn't have that much to do directly with investing, but I think it's a really good book to read. I think investors need a lot of mental fortitude, good physical health, but just calm minds, right? So I'm going to recommend a book called Breath or Breathe. Forgetting whether it's called Breath or Breathe. It's by James Nestor, and it's a book that teaches us how we should be breathing. And it's actually rediscovering pranayam, which is an ancient practice from India on how you breathe. But I'll give you a 30-second preview. The guy who wrote that book was suffering from really bad respiratory ailments, and it was, basically medicines were not working, and eventually he was sent to a breathing clinic where he was just taught how to do deep breathing exercise and so on. And he couldn't even do those. His health wasn't that bad a shape, and that led to him doing a lot of research into breathing. So he looked at Kenyan runners. Why do they win marathons? They're actually taught how to breathe differently. He looked at deep sea divers off Catalonia, off Spain, and how can they hold their breath for 30 minutes, 45 minutes underwater? They're taught how to breathe differently. So he realized that we've actually forgotten how to breathe, or we're breathing wrongly. And it's about rediscovering how we should breathe. And honestly, I think I'm guilty of not following it as much as I should. And, my parents have been teaching me this stuff since I was a kid, and we're just lazy. But I think it's a great time to pause and rediscover good breathing. It's really helpful.
Do you feel like it's changed your stress levels?
Big time. It really changes stress levels, 100%. It's extraordinary. And, very, very interesting stuff. So, for example, nasal breathing versus mouth breathing, you see a lot of artists, they even tape their mouths when they go to bed at night. There are huge benefits of nasal breathing. And actually, there are a lot of harmful effects of mouth breathing. Like there's, the pillows we use, for example, cause us to sleep in certain manners that promote mouth breathing and not nasal breathing and so on. But I think just looking at research, looking at other cultures, looking at history, and rediscovering how we breathe would be very, very useful for anybody that needs to be very calm and level-headed and kind of handle a lot of stress and noise that investors do these days.
Yeah, fascinating. I did not expect that suggestion. So yeah, where can listeners learn more about Smartkarma or follow your ideas on social media and such?
Okay. Well, the easiest is just on Smartkarma. So just go to our website, smartkarma.com. We have a free login. You can start your journey there. It's called a preview pass. We allow you to read executive summaries of every research piece, plus you get a whole bunch more for free, and you can stay free for as long as you want. If you're an institutional investor, you can do a trial, you can go further. If you're an individual investor, we've got Smartkarma Plus. which is again, roughly $500 a year. And I think it's a great place if you're a self-directed investor to spend a lot of time. And I think beyond that, just two other ideas. We've introduced a product called Smartkarma TLDR. You can again sign up for it from our website. We send you maybe one WhatsApp or Telegram message a day, so it comes straight into your inbox. It's like one chart with a one-liner explaining why it matters, and it's just a very accessible, interesting thing for anybody. Even if you don't have a stock portfolio, but you just are aspirational, you can start with TLDR. It'll be free forever. Or you can even follow us on Twitter. I think we respond, we engage, we post, we learn from others. So those are, I guess, a few different ways.
Cool. Well, thank you so much for participating, Raj. And yeah, let's.
No, Mike, thank you. Thanks for your time too.
Thank you so much.
Yeah, and keep doing the great work you're doing. We're big fans.